It's your professionalism that I respect.
Hi, Chris.
Stephanie Hayes, you're a sight for sore eyes. How are you?
Wait,
Happy
is that bad?
Thursday to you.
What does that mean?
No,
You're a site.
It means you're looking beautiful, you're looking spry, you're looking alert, you're looking like, you're ready to tackle a topic on how to found it. That's what that means.
Well, we are finally getting sun here in the great north, cold north, and it's really sort of rejuvenating me. And it's made me want to do some spring cleaning in my house, but we just moved here in November, so we've got lots of stuff still kind of in boxes and everything. And I've been trying to sell stuff, on Marketplace or whatever, and I'm just getting kind of tired of it. And I came across this box of like dead batteries, the rechargeable kind, but they're all dead. And I'm just like, do I really want, do I care? Do I need these? And I was going to try and sell them, but I'm like, forget it. I'm just giving them away. So I gave them all away free of charge.
I was trying hard to figure out where you're going to go with that dad joke and the free of charge. Well done, Stephanie.
Yeah.
Hey, you know what the best season is to jump on a trampoline? Springtime.
No.
Springtime. It's springtime. It's the best season to jump on a trampoline.
Springtime. Oh.
It's a spring dead. Spring.
Hey, well, I gotta go. So, thanks.
Stephanie, what if being irreplaceable is costing you millions at the exit? Patrick Campbell built Profit Well over 8 years, then removed himself from every decision before Paddle's $200 million acquisition. The valuation premium came from proving the business ran without him. Today on How to Founder, we're going to be talking about crossing the chasm from founder to executive team. Why the businesses that grow biggest, easy for me to say, are the ones that learn to run without their founder at the center of every decision. I'm your host, Mr. Chris Franks. With me, the lovely Canadian Stephanie Hayes. We're supposed to have a guest, but I think that maybe we're not inviting guests anymore. I think that maybe our calendar invite thing is broken. So very sorry. You just get Stephanie and I today. But as we were talking before, this is a world that you live in quite a bit, Stephanie. And so I think that this is something where we can start by saying, what is the problem here? Why is it that founder-led companies, small companies that are selling, and we're talking about PEs, but this is not just about PEs, really. It's about any exit. Why is it that sometimes these deals fall apart or they get a lower valuation when you are a bigger part of the business and you are, let's say, irreplaceable? I mean, I guess I just answered my own question, but frame this up for us.
Yeah, I mean, this is a pretty classic situation that a lot of founders get themselves into, right? Where they are, whether they're trying to save money or they're, they can't let things go, or it's a control thing, or it's, whatever it is, they get themselves into a position where they are indispensable. And from a valuation perspective, that's a big red flag. And so just, if you understand how valuation works, it's not just about crunching numbers. There's a whole other piece that happens, which is all the risk adjustments. And there's a whole set of questions that we go through when we're working with a business around operational, maturity and diversification and, probably 100 questions. And all of those questions from a buyer's perspective are going to adjust your valuation. So, the idea around a founder-led business and everything being dependent on the founder, that's a risky business for a buyer to buy, because I bought one of those businesses and it was risky for sure. So you being completely the center of everything, and the business even the business just being dependent on you in one way or another lowers your valuation, and that's kind of what there is to it.
I want to start with a broader question because this is something I certainly didn't know when I started out. You kind of hear that you start companies and then you sell, and people get rich because they sell these companies. How are companies valued? And there's this thing called a multiple, or sometimes a multiple of EBITDA. It's kind of a nerdy saying, but before you start to take money away, how is the broadly do you look at valuing a company?
So, a lot of people think they just have to pile on the money to get, more revenue, but revenue only tells you sort of one part of it, right? Yes, there's a multiple that would be applied at valuation, and that depends on the industry you're in and how old your business is. Um, but your multiple can change uh, based on how the deal is structured. Like we're building a private equity fund just this week, and it's going to be a roll up, and it's a roll up of like businesses, which means that our multiples are going to be a whole lot more than if I was selling each of those businesses independently. So there's a lot that affects the multiple that you have. But I think what a lot of founders don't understand is how important the way you run your business is in valuation, and that whether you're doing an SDE calculation in terms of the base number, or you're doing EBITDA, or you're doing some other type of calculation for your valuation, your base valuation, all the multiples and all of the risk adjustments are the things that actually affect what your ultimate buy price is going to be. And those can be significant. So what we do is we try to work with businesses long before they're even considering an exit, specifically targeting the things that have risk adjusted their valuation. So your growth strategy over 5 years is going to be focused on eliminating those risks. And one of those risks is very much how dependent are we on one person, one market, one product. And this is very typical. Yeah, one customer. And sometimes the business owner will be like, yeah, I don't want to do that. Like, I'm fine with that. I'm like, great, that's okay. But we'll work on the other things, right? So when you build a growth strategy around where you're getting kind of hosed on your valuation, that's pretty effective if you really think you're going to make an exit.
I want to press on this point just a couple of more minutes, just because I don't think it's things that most founders understand when they start companies, which is what you just suggested is that multiple different industries and different verticals have different multiples. So all that is saying is that you take your revenue and you multiply it by some number. Now, the way that most finance people look at that is something called future discounted cash flow. It's a very complicated mechanism, but at the end of the day, if you're starting a marketing services company like I did, or you're starting a SaaS company, those have very different multiples, to the point where a services company, you're going to get maybe 1x multiple, maybe 2 if you've got some stuff going, right? Versus a SaaS company, at one point in the heyday of SaaS, software as a service, you're getting paid every single month. On the heyday of SaaS, they were getting 12x. I've heard of a couple of 13x's, et cetera. Right?
You'll never see that happen.
Yeah, not anymore. Not anymore, but at one point in time, SaaS valuations were really high. And so I want you to just talk me through, with that kind of understanding, you start with this idea that depending on the industry, there's individual multiples. You work, I think, a lot in the individual services industry. So you're not talking gigantic multiples. But how do you start to go in and look at a company? What are the mechanisms, even before you start to do risk discounting with what the founder is? I know that's what we get to, but just what are the mechanisms that you start to look at?
Well, the first thing that you want to, and so we're actually working with clinical businesses. So this is a very repeatable business model. And what it means is that you can start getting really targeted on your valuation and your understanding of, what affects these businesses. But before you even get to multiples or risk adjustments, you have to pick the right valuation approach. And for sort of founder-led businesses that are in that kind of early seven figures, let's say, you're usually going to do SDE, which is seller's discretionary earnings. And so that's very different than EBITDA. And EBITDA is just numbers. Like it's just your earnings before interest, depreciation, and taxes. Seller's discretionary earnings is kind of interesting because it's actually looking at how much the owner of the business takes from the business. And the more that the owner takes from the business, the higher your valuation, which is like then it's a totally different strategy than if your EBITDA valuation is, driving you to get more revenue into the business and reduce your costs. So the valuation approach that you take, and it's not arbitrary, right? Like there's certain types of businesses that you would use SDE, and there's certain types of businesses that you would use EBITDA, and then there's other valuation strategies as well. So just starting there changes how you're going to calculate what strategy you're going to use to grow in the next few years to get to a better valuation. So knowing that is super important because you can't change your history when you get to that proper valuation exercise. So if you have been growing the business to maximize revenue, but you're going to get valuated at a SDE, now you're kind of shooting yourself in the foot. So it is actually really important for owners to know these things if they're going to have an exit or plan for an exit at some point.
It's just one of those things that, and this is the reason why this show exists, Stephanie, is because this is shit that nobody ever taught me.
Right.
There's this question mark. You sell the company and then you're super rich. Nobody ever really explained like, hey, what is your business actually worth? And then at some point, if you're building a good business, maybe a business broker or maybe a banker or something will come along and be like, I think you could be worth $100 million, which is not true. It's just supposed to get you interested in this process. And so it's this very, very interesting component that I think it's super important that founders start to understand what the exit math is. I don't want to say probably before you start the company. Because it goes to your why. If you genuinely want to be a billionaire and you want to start a company that's you're gonna work for 5 years and then never work again, don't start a services company, right? Don't do what I did.
Or me, right? I've been in services for 25 years. But I think the other side of that is I think a lot of founders don't really realize that selling is even a thing for them or an option. And when they start thinking about it, this is the conversation I started having with all of my, small business community years ago, 5 years ago. And I was like, listen, why are you not focusing on building assets inside your business? And so, we've had this program, Assets to Exits, for, quite a number of years. And what's really cool is that it has changed these business owners' decision-making, like what they're going to invest in, what they're going to use their time for, because they want to build things that are going to benefit the business. So what is considered an asset when a buyer wants to look at your business? So instead of just going and investing in marketing strategies to get more revenue in the door, these service-based business owners are now trying to figure out, one of them is building an event that becomes branded every year and that she can sell almost like a product. And another one is building a framework that she can sell to other agencies. So it's the productization of services. It's the IP. Lots of service-based business owners don't understand that they've got assets inside their business. And if they want to continue being a service-based business, but also have some value in the business, start thinking about what you can create. You've got assets inside your business. And that thinking changes the trajectory of their business. Even if they're never planning on selling, or they just want a legacy business, or this is lifestyle, you never know, right? You can sell I've bought businesses for $500. You can make an exit and you can sell something. There's always a market for it.
I think it's a and what you're talking about is a moment in time in almost every founder's life, which is we start with this idea that I'm good, or I'm very interested in solving this problem. And somewhere along the way, you have to make that moment, that pivot to be a CEO. And you have to learn things like finance and corporate finance and how companies are valued. And I think that you don't have to be an expert in that, because that's why people hire you, Stephanie, but you do need to start to think about your company differently, from something that funds your lifestyle, where you get to get paid to do the thing that you like to do, to something where now you are actually thinking of your business as this entity, as this thing that has value. And that's always an interesting shift, I think. Like for you, what was that shift like?
Well, let me turn the question back to you, because you did go through an exit. So when did that shift for you? Like, you built a services business, you know what that looks like. When you went through the exit, when do you remember starting to kind of believe that this could be a thing for you? And the second part of that question is, what did you change when you made that shift?
It was 2 weeks after the check cleared. That's when I believed it was real. I had to wait for the full 2 weeks. Like, there's so many stories of people that like deals fall apart in the 11th hour and things like that.
Oh, yeah.
But even after, and then, I've been honest about my first exit, which was I was building that company to sell it, and then I sold it, and then ended up in, 4 rounds of a federal lawsuit, including bankruptcy and liquidation. So like, even after you sell the company, things can go terribly wrong. And so it was like, when the check cleared and it didn't go away magically, is when I believed it could do that. So I think that even though I'm an experienced founder, even though I'd sold companies in the past, when I started Clever Funnel, it was not with the intention of selling it. It was the intention of getting a paycheck, of doing something I like to do and work with a bunch of cool people that I like to work with. And so it took a very long time for me, like 3 years probably, to be like, we've actually built something here that's real. And also internally, you're looking around and just being like, we can't tie our shoelaces. Like we get all these things wrong. Nobody's going to want to buy this, hunk of junk. And it takes a little bit of a mind shift to do that. What really helped me was I went through EOS. Our friend Hark, who's been on the show, was our EOS implementer. He came in and helped us get through and start to systematize the business in a way that I could tell the story that it was valuable. And it's one of the reasons I'm such a fan of EOS.
Yeah, and I like that actually is really good news for me, because what I'm building right now is a clinical operating system, and it's kind of an EOS for a clinical business, right? And these guys are typically practitioners that are like, I'm going to start a clinic, and they're not business people, and they don't know what happens once they start to make some money and how to grow and how to, and it's a little untapped resource. So that is part of it, is like the operationalization of the business, and having that sort of rigor behind the business can make it infinitely more valuable. Because if you think about, like, as a buyer, for me to buy a plug and play business is so much more attractive than buying like a renovation business. Maybe I can get it cheaper, but that's a lot of work. I'd rather buy something that I can just sort of turnkey and then keep growing, because there's such good foundations. And
I want to
guess
wrap this part of the conversation up just with like, there are different, you just mentioned a couple. Why do people buy companies? And in this case, let's look at the private equity situation, because there are so many people right now. Private equity space is relatively hot. They've come down market into the small business space. They're doing a lot of roll-ups. That's the business thesis that you're going to be doing with your private equity fund. What are those different reasons why a company would get bought? One is cash flow, right? It's just going to be spitting off free and clear cash. You can use that cash. What are the other reasons?
Well, it depends if you're an individual buyer or an institutional buyer, right? So you go and you look at what Cody Sanchez is, got going on, and she's encouraging like regular people who have some money to spend to go buy these boring businesses, right? To go buy these businesses that are recession proof and just have cash flow, and you're kind of just all buying your way into entrepreneurship, which Walker Dybel does, and like it's great. It's called an investorpreneur. And so there are those buyers that are just going to want to buy their way into an existing functioning business, but they're not, that's not the buyer who buys a roll up, right? A roll up is bought by a bigger, maybe institutional investor who has been around the block, knows what they're doing, and they're like, great, I'm going to buy a turnkey business that has proven revenue, or turnkey portfolio of businesses that has proven revenue. And with the resources that we have, we're just going to kind of ignite that and put, more of the same behind it. And that's just a business. It's just a business decision, right? It's a good investment decision. Buy a roll up of a bunch of businesses that have been treated over 5 years to be consistent. It's the same kind of thing, but it's just at a bigger level. So they're buying because they want something. You don't buy like I did, where you buy a failing business, right? I just happened to have built that business with the client who owned it, and I wanted to take it over because I knew how to run it.
But there are people that do that. There are people that do turnaround businesses that will buy distressed assets and try to turn it around.
Totally, but you better know what you're doing then, right? And you better have the resources to be able to do it.
And that's a very difficult game. I speak from experience.
Very different purchase, very different experience. I don't recommend building a business to attract that kind of buyer, right? You're attracting that kind of buyer when you're in desperation. So you're going to get, pennies to the dollar. But everyone's goal who is even thinking of exiting should be to maximize the value that they're going to get from their business. And, once you get into the private equity space, it starts to become really interesting because it's almost like just a game of money, right? You're looking at numbers in bulk, and your big institutional buyers are like, great, I'm not going to go and do a deep dive investigation in every one of these 20 businesses inside this roll up. Just tell me at the portfolio level what's happening. So again, you could end up in a situation like that where you're acquired we're not actually acquiring these businesses, we're acquiring a stake in these businesses, but we're applying all of our growth tools and growth operating system to make these businesses, and we all share in the outcome, right? So it's kind of like the best of both worlds, or best of three worlds, for the buyer, for the seller, and for us in between that are actually facilitating that growth, right? So I think you have to, if you're smart, you're going to start thinking about what kind of exit you want to do and what kind of numbers you think you'd like to try and shoot for, and then start planning your growth strategy, particularly for that exit type. I have a question for you, though, because
Sure.
One of the things he talks about is post-exit. So what happens to you as someone who has exited a business emotionally and financially and all of this stuff? Because everybody thinks it's just like a ride off into the sunset kind of thing, but there are a lot of things that can happen, right? And I know you and Anthony can both speak to this, that sometimes post-exit,
good and the bad.
Yeah, sometimes post-exit is not quite the party that it seems like it could be.
I'm going to just put a wrapper on this. I'm going to answer your question. For different types of assets or different type of sales, there's always the cash flow sale, which is you're spinning off free and clear cash, and people will buy for that. There's also asset-based sales, and I think we'll probably get into that. But classically small businesses that have bought their land and own a chunk of land, and it's like also maybe have some free and clear assets. That's a bigger opportunity. And there's other types of sales. And then there's the synergy sale, which is if I put two companies together, I can save money and have a higher, more or less margin. So those are all types of exits. To answer your question is on the post-exit side, and this is something I think every founder needs to hear. It's terrible. It's a terrible time. You have lost a part of yourself. That was part of your purpose. I knew that I needed to get out of CleverFunnel. It was killing me. I was 20 pounds heavier. I was drinking too much. I was eating too much. I was not healthy. I was not sleeping. I was not in a good mental place. I knew that I needed to get out. At the same time, when I sold it, it just was so lonely. it was this sense of, I had this group of people that I cared about. We had a shared passion, a shared mission, and we went and we worked hard every day to serve our clients. And then you wake up on a Tuesday, and I was a volunteer dog walker at the local pound, which was great because I love dogs, and they're good listeners, by the way, for therapy. Good therapy. You could just talk to the dogs, but it is a very difficult time, and I don't think that I factored in how difficult the post-exit would be in that transitionary period. And it was a year and a half before I landed here at Promptus, and it was a lot of struggling and searching. And I'm later in my career, and so I didn't know whether or not I still had it in me to go found another company, or whether I was too old, or maybe I should go be an operator, or I love teaching, so maybe I should go try to teach more. It was a really tough time. I'll tell you the one piece, and this is just the thing that I want people to have as a takeaway, is I felt so indebted to my employees and the team that I had built. And we're still close, but they're not your family, they're employees. And so when I left, somebody else started paying them. And that loyalty went to the people that were paying them. And that's okay. It's how it's supposed to work. But for some reason, I had this idea that, we were going to have that same relationship. It's just not the same once you sell the company. Your experiences, similar or different?
Yeah, I mean, I would say, like, in the .com days, we were going through exit after exit after exit. We were incubating businesses, and there's almost a little bit of like a piece of you that gets lost when that business gets sold and handed over to someone else. So in our assets to exits program, like, there's a very intentional piece around preparing you for post exit, because I think that there's all those things that you just talked about, right? There's this guilt. Like, a lot of founders who exit feel guilt. Did I do the right thing? Did I just take advantage of somebody? Did I just leave my employees in the lurch?
Yeah, and your employees call you and be like, "This new boss is a jerk. I don't like him. I want you
Right.
back." You're like, "Oh,
Right.
so terrible."
Yeah. And then your sense of purpose, right? What happens to your sense of purpose? And, maybe dog walking is it, but the founders who go into the exit having done this work first versus the founders who didn't, it's really significant. And I've seen founders who post exit who are pretty close to, like, suicidal. Like, they and I don't say that to be dramatic or funny. Like, it's actually a thing. So I do think all that preparation and all of that mindset work before you go in, and what are you going to do next? Like, are you good and you just want to take a rest, or do you need to start working on another project just to, like, deal with that sort of purpose piece? So there's so much of it. And I think, like, if you're planning for this 5 years out, you got a lot of time to kind of do that work. But if you're getting into a position where you're like, oh my God, I have to sell, you don't get the chance.
It's terrible.
Yeah.
I wish I had met you before that, and I wish we had had the conversation, because it was a tough time.
Yeah.
It's there. You can go through that. I think that the other piece, and this is, I've talked to a couple of founders lately that have gone through a couple of exits, and there's this almost moment where you're that frenetic energy, that ADHD energy that we have as founders. You feel like you got to go jump into something else, and you have to, like, I got to go start working on this thing right away. I got to go. I've had it in my mind, so I'm going to go build this thing. Very rarely does that work out. You need a little bit of time and space to remove yourself from that previous business. And so there is a moment where you, even if you've planned well, you need to take a little bit of a mental break to be very thoughtful, because starting companies, running companies is brutally hard. It's brutally lonely. It's a difficult task. It's why we do this stuff. Thank you. Agreed. Yeah. It's is take a little bit of time and space. All right. So Stephanie, I want to get to the meat of this, which is do you want to put a point on that before we get to, like, what do I need to start thinking about as a founder?
Well, you actually kind of caused me to think about your experience and had a question for you that your first business where you actually built it to sell with the intention of selling, was that a different exit for you?
I mean, I've been very honest, like if anybody that's ever been to Denver Founders or any of the other stuff, it is a genuine horror story. So I sold the company that bought us did not pay us. And so we made every mistake in the book. I didn't know there were mistakes. It took me a long time to give myself some grace, but yeah, the exit itself was terrible. And what I'll tell you, Stephanie, is that exits can go wrong. There is 100 lessons, including my primary lesson, which is when somebody says, "Can I please buy your company?" And then you say, "Sure, I'd love that." And they say, "Can we see your financials?" Your next response, please, for the love of God, founders, say, "Can I please see your financials too?" You're under mutual NDA, meaning that both of you agree that you're not going to say anything. Look at their financials. If they're a publicly traded company, just look at their K1s. But otherwise, not K1s, the big public offering stuff. But if they're a private company, look at their balance sheet, because I would have seen that company was leveraged to the eyeballs and had no way they could actually pay for us. And so I would have never gone down this painful road. So long and short, I learned a lot. It was a terrible time, but you want to talk about the double whammy of losing a company and then feeling the shame and just absolute morose of making terrible financial decisions and putting my family in a terrible financial position because I just saw this exit.
Yeah.
The exit didn't happen. There was no money. I still to this day have not been paid. My biggest joke is at liquidation, the single asset the company had bought us was a warehouse full of voice over IP phones. You want to buy a voice over IP phone, Stephanie? I have to explain what voice over IP phones are to my students. They don't even know what they are. It's like, well, we used to have these things called telephones, and you'd pick them up. It's like, yeah, there were those. Wow. Not a big market for those these days, Stephanie.
Not today, no.
Yeah. All right, so let's talk about how should I start thinking about this as a founder? And you mentioned this idea of building assets, and I think it's a brilliant way for founders to start to frame this problem. What does that mean? Just explain what it means to build an asset in my company.
Well, if you'd like to go on my website and sign up for my freebie, there's 9 different types of assets you can buy in your business. You can build inside your business. And this is based on what people will pay money for, right? And what increases your valuation. And it could be I'm not going to go through all 9, but it could be anything from, your audience to a list of customers, to committed contracts, to productized services, to products, to investments that you've got. There's all sorts of different types of assets that you can build inside your business that you may not even be aware of. So educating yourself on what a buyer looks for, I think, is probably the best place for you to start. I did all of Walker Deibel's stuff because I was just interested in it, but he speaks to the people who are buying businesses, and his book, Buy Then Build, I think it's called. If you read that book, you get a really good sense of what a buyer is looking for when they're evaluating a business. Start there, because that helps you back into what you should be doing inside your own business to make it more valuable. And everybody's so focused on building revenue. Like, yes, okay, a company that has good revenue is obviously going to be valuable, but you may get totally tanked on your valuation because you have no operational integrity, because you have so much dependency on, a person or a market or what have you. So that understanding of what a buyer will be looking for is probably the best thing you can do to educate yourself on where you should be shifting your decisions. Like, I have seen business owners build totally new business models because of this, because and actually they end up being relieved because they don't feel like they're constantly chasing revenue. So I would say start there, understand what a buyer is actually looking for, and then you can understand where you should pay attention in your business.
it's very similar to the advice I give people that are raising money. Brad Fell wrote a book. Brad
Yeah.
lives in Boulder. Famously, he wrote a book called Venture Deals, and I think Jason also wrote it with him. But it's like anybody that wants to raise money from VCs, you should read that book because it talks about the math and how these deals work and how they're structured. It's the same idea, is that you're not selling. It's such a basic concept, but it's something that you have to understand. They are buying your business because they wanted to make more money. They believe that asset, they can leverage that asset to make more money. So the story you have to tell is how they do that. Whether it's like, hey, look at all these assets, you could make it apart and sell it. You could spin it up and sell it. I have all these other assets in the business, right? All of these things, it's so basic, but you have to be able to tell that story to a potential buyer of why this thing is going to be worth more money when they buy it than when you owned it. And I know it's a crazy thing to think about, but that's exactly what you need to tell, right? I mean, is that how you would position it?
Yeah, and it's different than what you would think, right? Everyone thinks, oh, we just need to make more money, make more money. But listen, these guys are not stupid, right? These women. We are selling businesses only that are owned by women, by the way, which is sort of interesting. But the people who are evaluating the business, they're not dummies. And they're looking for things like, you can't tell them I've got $1.5 million in revenue and not expect them to also see that you've got $1.3 million in expenses. Like, I'd pay a really different number for that business than one that has $500,000 in expenses, right? Like, you got to know this stuff. And so knowing this stuff is what makes you more informed and helps you build a strategy that's going to be focused on an exit.
I will get to the speed run in just a minute, but I want to kind of put a point on this part of the conversation, which is, even though that this is a cliche and even though it's overly broad, it's easier to sell your business if you're running a good business. And that means that you have margin, you have cash flow. And remember, cash is king. Every corporate finance class is going to teach you free and clear cash flow is the goal of any business because that gives you optionality. But what else? What are the other components? And this is simple stuff like we were taught growing up in our generation of being a founder, Stephanie, to have a physical binder that was your founder book. Now it's all in Dropbox, but you can just keep your stuff organized. What does it mean to run a good business?
It means that you have paid attention to all of the things, your people. Like, as a buyer, I want to see consistency. I want to see like growth, right? It doesn't have to be like hockey stick growth. If I see a business that's growing consistently over time, and I want to see that there's market opportunity, that there's, this is why we're in the business that we're in right now, building this PE fund, because it's like this sweet spot of all these things. It's recession proof. People always spend money on their wellness. It is, there are so many of these clinics starting up. There's a lot of demand around GLPs and peptides and weight loss and hair replacement and testosterone and like all this stuff. These are small little businesses that are in the sort of $1 million range. Like, you have to know your market and you have to understand what's coming down the pipe from an interest perspective. So all of these things are super important, but getting consistent. Like, I don't know if you read that PitchBook article about the roll up that was just sold for like bajillion dollars.
Yeah, you mentioned it. It's like that's where PEs are playing most. Yeah, it's
garage door. Right, yeah, but they were all that portfolio owner. Like, that's what we're going to become. Is they had spent this time to make sure that each of these businesses had this consistent operating foundation, and that they were in a position to grow, and that they were demonstrating growth. So if you can demonstrate growth, again, doesn't have to be hockey stick growth, but just demonstrate that there's possibility for growth and expansion, that there is consistency in your revenue, and that you are operationally have thought through everything, that you understand your market, like all those things, and that you have good people. But then that's also like a flag, right? Because if your valuation is entirely dependent on your people, that's a wobbly foundation, because that person can up and leave tomorrow. But what you're also demonstrating is that you know how to find good people, and that good people are going to be attracted to your business because you have taken care to build the right team, right? So, I'm looking for all of those things that I know I can sort of turn the lever. And I might be a different kind of investor than others, because values alignment and the type of business you're running actually really matters to me. And there are more of those investors out there, more and more. Like, we're a women-owned private equity fund. We have an advisor that works with us, and he's male, but just because he has the experience doing this stuff. But this is all women-owned businesses, women investors. Like, that values piece is starting to become more and more important with investors. And there's still like your gross investors out there that'll just like, pump and dump, but it is a trend, right? Like, there's more of that intentional investing happening, which is great. So
I know we have to get to the speed round, but we have to get to this point, which is because it's the point of the episode. What steps can I, as the founder, start to take now to make myself replaceable? Because ultimately, in a transaction, if you become the key asset that stops you from being sold, that's bad, right?
Yeah.
If you become the person, and to your point, is you'll risk adjust down if that key employee, which turns out to be the founder, is like, and then you may end up having to work for the new owners for a year or 2 years in an employment contract. There's all kinds of other stuff. But what can I do to start to replace myself in the business?
Do you know what the biggest thing that keeps people from getting themselves out of that dependency? I built a whole program around this because it's so pervasive, is their own mindset and identity. So you can replace yourself in your business very quickly and very easily if you allow it to happen. But these guys get stuck because as soon as they step out of that role, all of a sudden they feel like they don't have any purpose inside the business, that they're less important inside the business, and they immediately go back to doing like detail work, like little busy work, because it feels like you're doing something. So you got to have some mindset work before you even start this. And then the process of getting yourself out, it's easy. Like, it's not that hard. And for the most part, when they cross that threshold of finally, and it takes like 6 to 8 months for a founder with intentional work to finally get there and do it, which is super frustrating sometimes when the business needs it. But most of the time, that's true. The business stalls growth because the founder is sitting there being the bottleneck or being the one who's holding the business back. So the very first thing you need to do is get your mindset right, that you can and should, and it's good for you to step out of this dependency role, because most of the time the business actually needs you to do it anyway. So letting that go and doing the work around your own identity and your own purpose is the first step.
It's so easy to say, and it's so hard to do.
Oh my God, so hard. And it's frustrating. It's frustrating to be a person that sees it, that I'm like, okay, you're stalled because you won't get out of this, wherever you started. Like, you're the practitioner, you're the doer, this stuff really well. Get out of it, because the business now needs you to get out of it. And they won't. They always find their way back into something because it feels like it's doing something and contributing. And it feels like, when I step out of this becomes all uncertain to me. It's not like you're stepping out to just like sit on the couch and eat bonbons, although sometimes that actually is better for the business for you to do that.
Exactly. Just get out of the way.
Yeah, once they make that transition and they actually do it, it is incredible to see how much better the business does and how much better they do. Like, it's a relief for them, right? And then they can start to invest. So you have to sort of like lead them into it and get them to have a few wins in the new role. And then they can let the stuff go. Because most of the time they want to let the stuff go, but it's their identity.
It's you desperately want to and can't, which is a very strange dichotomy, but very real. I'm going to show you how to do some founder-led sales right now, Stephanie. I believe this is called the assumptive close. I believe you're ready for the speed round. That was.
I wasn't emotionally ready.
I know. I think that
I've never had to do the speed round.
Really? This is your first ever speed round?
Oh my God, I'm going to pee my pants.
Stephanie, do you delegate your weaknesses first or delegate your strengths first? Answer the question, Stephanie.
Weaknesses. That's the easy part.
New VP makes a $200,000 mistake in the first quarter. Do you fire him or keep him?
It depends what the mistake was.
Also, yeah, I don't know who you're paying $200,000 to. I want that job. That's great. How much of your revenue walks out the door if you do?
Oh shit. Can we ask the question differently? How much revenue should walk out the door if you do?
Yeah,
none?
Zero should. Right, exactly.
Wait. Say that word again, the R word.
Revenue?
So interesting. You Americans say revenue, and we say revenue.
Revenue?
Revenue.
I'm Texan. I'm not an American. You know that. I don't speak English. First executive hire, COO who replaces you, or CFO who monitors your growth, or some other executive team hire.
COO.
PE comes knocking before you're ready. Do you take the meeting? And I'll say not only PE, maybe a banker, maybe a business broker. Do you take that meeting?
I'll take the meeting because I can learn something from it.
Agreed. Stephanie Hayes, what a great conversation. Deep dive resources, rocket fuel. I would say anything by Gino Wickman. Traction famously is how he lays out EOS and some of those operating systems. I don't take the stuff he is verbatim, but it is a good system. And then the CEO Next Door by Elena L. Botelho and Kim R. Powell. However, Stephanie, first time ever doing speed round, also first time ever to get to pitch your stuff. Where can we find out more information about you? Where do we go? What website do we go to? I'm going to quickly put this in a comment. So
I'm one of those people that just kind of does their stuff. So you can find me at stephaniehays.biz, but all the work that we're doing with our business Grow to Sell, we don't really, it's not something that we do over a website or whatever, but yeah, you can find me at stephaniehays.biz, and super happy to have a conversation. You can find me on LinkedIn where I hang out.
So
look at that. You can go download the 9 types of assets you can build inside your business and just start thinking about it from there. It really changes how you make decisions inside your business.
I was just making sure I didn't misspell your name on the banner that I just quickly put up. That would have been very, very embarrassing. What a great conversation. I think it's so interesting. And again, working your way backwards from thinking about exits is really, really critical. Loved it. Stephanie, why don't you get us out of here on a Thursday?
Oh, why don't I? Listen, we are so excited to have you listening. We think that entrepreneurship is, what's going to save the world. And we are so supportive of all you guys who are out there building and trying and being courageous. Thank you for listening. You can find us at howtofounder.com. Please give us a like and a follow. If you didn't like it, that's okay.
I'll comment on Stephanie's LinkedIn. Just get her.
Yeah, go comment on my LinkedIn and tell me there. I'll definitely be listening. Thanks for listening. Give us a like, give us a follow. Give us some comments. If there's something you want us to talk about, we're super happy to hear it. And you are the future of economic growth. So keep going and keep building, and we are here to support you. Thank you all. We'll see you next time.
It's almost as if you have no business training at all.